Hello and happy Monday. Welcome to the Purse Strings Lunch and Learn that we have here every Monday or our Money Monday. My name is Maggie. I'm a partner here at Purse Strings, and we are all about providing tips, tricks, pieces of advice, all to be financially fearless. And then when you're ready to start planning for retirement, get a will, sell a house, maybe you're getting divorced, maybe you're getting married, whatever financial transition or transaction you're going through, we have top tier financial professionals willing, ready, and able to serve you. We call those our Purse Strings approved professionals. And Zahya is here as one of them to talk about retirement in a down market, which I know is a super top of mind topic these days. So we're excited to dive in and have this conversation. But before we get started with all that fun, could you introduce who you are and where you're from?
Thanks, Maggie. As Maggie mentioned, Zahya Beall with MONECO Advisors. I also go by Z, so if you're ever reaching out with questions, feel free to just make it easy. And I am based in Connecticut, so I am working out of Fairfield, Connecticut. It's about 45 minutes outside New York, but I work with clients all over the country. And so I tell you, my second largest base is actually in California, and then in Chicago, and some folks in the South. So I've been in the business since 2004, so going soon on my 20th year here in the business.
Wow.
And I know
You're
it's
too
hard to
young for
believe.
that.
It goes fast. And I'm just really excited to be on today and hopefully answer any questions, make sure the topics are relevant to what folks need now.
Awesome. Well, we're excited to have you on today. And anyone tuning in, if you have any questions while we're live, please throw them in the chat. We're happy to help answer those. And if you are watching the replay, you can still throw them in the chat and we'll come back around to those. So, retirement in a down market. We have all seen this, the stock markets, the S&P 500, things going down, which makes people very anxious. And I know you're getting a lot of, clients coming to you talking about this as well, right?
Mm-hmm.
And so where do we even start kind of with this anxiety and how to kind of go about planning a retirement when the market seems really down?
Yeah, I think that ultimately one of the things that I would say, it sounds very cliche, but if you talk to advisors and you're listening in to sort of the financial literacy that's out there, is they would tell you you need to invest for the long term. And I think probably the biggest value that comes along with working with a financial professional is that keeping the long term in mind is easy when things are good and not so easy when things are difficult. So what I share with clients that I think is really good to remember is that last year was an extraordinary year. And I joke kind of pithily that it's extraordinary in the way that your doctor uses the word. Like, you don't really want extraordinary results when you do a doctor's exam. But truly, it was extraordinary last year. And it was extraordinary for a number of reasons. But ultimately, last year is not a normal year. And so we don't want to plan around our strategy on the outlier years, but we also need to know that whatever plan you build needs to incorporate a year like we had in 2022, because we do know they happen every couple of years or every so often. I think one other thing to note that sort of exacerbated the feelings of last year is that it had been about 12 years since we had a really tough market.
Oh.
Yeah, so even since COVID, in 2020, February to March 2020, the market did drop almost 34%, but then it rebounded within a month. And it happened at the moment that we were all trying to figure out work, school, home. And so I think people didn't even have a moment to really open statements and see that before it recovered. So I think that it's really important to keep the long-term strategy, even though it's difficult at times, and to stay invested. We can look at, for a moment, a couple of images. We can look at those in a minute, but there are some things that may be helpful from an educational material point of view to show that as well. Let me stop there. Yeah.
That's really interesting because I had no idea that last year was kind of a fluke, or that odd year out of 12 years, which looking back, 1 out of 12, that's not bad. I can see how that'd be very anxiety ridden if you are getting closer to divorce, but really statistically, it makes a lot of sense that we would have a year like that.
Absolutely. And I'd say it's definitely extraordinary in the sense that usually we do have some sort of market challenges in a market cycle every 4, 5, 6 years. So 12 is unique.
We are almost due for it.
Exactly. Yes.
Awesome. Do you want to bring up your pictures next? Otherwise, I was thinking we
Sure.
could, yeah, we could do that.
Okay. I just want to
Just,
show briefly, I think, a few things that are useful to keep in mind. So I think a lot of clients are asking right now, and this is the normal part of investing, that really having a financial partner who does this for a living can help. This is the big time where we come in. The natural feeling is, after last year and everything that happened with my portfolio, I think I want to take a moment and sit it out, or I want to sit in a money market or sit in cash. And I think that this really does a good job of exemplifying why you need to be careful about pulling your money out and waiting for a certain time to get back in. We talk a little bit about this with clients, is that when you take money out, that also means you have to put money in at some point in the future. You're trying to market time, and you need to be right twice. And we know that market timing is really difficult. We call market timing a fool's errand, because if it was that easy, everybody would do it. So know that it's not you that can't market time. Advisors don't know the timing. Institutional investors, pensions, they don't know the timing. We're all trying to do the same thing, but we're trying to make sure that we do it in a way where we remove the element of market timing, because it's impossible to do. So what you see here is just showing, if you were to put $1,000 in 2012, what would happen. And ultimately, you'll see that if you just stayed invested, even with difficult markets, you would almost have doubled your money twice.
wow.
Versus missing some of the best days, it's almost half the value of what it would be if you miss only 10 days, the best days in the market. What I would also say is that the best days tend to come in the midst of the hard times, because if you think about those institutional investors, their job is to be active daily in the market. When the market's down, that's a good time to buy. So you want to think like an institutional investor, buy when things are down.
Mhm.
So one of the things that you're doing, if you're in your 401k or usually in your IRA, is that you're probably reinvesting proceeds that you don't even realize you're getting. So if you own bonds, you get interest and income that comes off those bonds monthly, quarterly, or semi-annually. And if you own stocks, high value established firms, some of them may be paying you dividends quarterly. So both of those are income streams coming out, nothing you need to do. But if you're reinvesting those while the market's down, you're buying more shares than you could have got when it was just up. So it's a real way of compounding your returns over time.
It's like a discounted rate.
Completely. It's buying low.
Yeah. And I like how you pointed out there that if you try to time the market, which is very almost nearly impossible to do, you do have to be right twice, when you're jumping out and when you're jumping back in.
Yeah.
Which, getting it right once is a lot, but much less twice is even harder. I mean, it seems like to me. So it seems like it's much better almost just to set it and forget it, or have someone else take care of it. Don't pull it out, rather than really try to play the game of getting it in and out.
Absolutely.
And so then I know when it comes closer to retirement, let's say when you're about, let's say maybe 10 years out or a little shorter, you really want to have different buckets of income,
Yeah.
short, medium, and long. Can you kind of dive into that, and why this is important and how you kind of set that up?
Yeah. So then when we get to the clients that are, like you mentioned, 10 years from retirement, whether that's 55 or 60, it's different for everyone. What we try to start doing then is we'll sit down and we'll build a plan. And the idea is that there are those three buckets: your short term bucket, which is usually your next 1 to 2 years of expenses. Then 3 to 5 years is the medium term bucket. And then anything else is long term. The whole idea is that year 1 and 2, we want to work with you for something that's a cash like vehicle, meaning it's available and liquid at any time, that will cover your next 2 years' expenses. And if you think about that, if you knew last year that no matter what's happening in the market, I've got 2 years' expenses saved. And then even if we have to go through that for a medical or health emergency, I've got another bucket of 3 to 5 years that's a little bit riskier, but also still built for short term. Now you're saying it's 5 years of income prepared no matter what happens in the market. We know that the longest market drawdown is 3 years. So we're almost doubling that by setting aside a strategy that insulates you from what's going on. And what we found is with clients, that really helps to point back in a year like last year that, hey, we have plenty of time to recover, and we know that's the whole strategy, but you're safe because we've planned for it.
I like that. And so you don't have to take out of the market that's down right now, but you already have your funds put aside. So you have about 5 years for this to go back and grow, which granted, it's probably going to rebound, maybe go down and go back up again in that time. Because as we know, this, it really fluctuates unless you try to play the game.
And I think it's important to note that we recognize that 5 years of cash is not something you want either. So it's about finding a way. That's why there is a short-term bucket and a medium-term bucket, because the short-term is invested in stuff that's different than the medium-term bucket. But it's about efficiently having enough money on the sideline, but still earning something on that.
I love that. I love that. And then, a lot of people, we talk about, just the anxiety that comes with this. And, we always recommend to be in contact with your financial advisor. And so how often do you think, especially when these markets are kind of crazy, should you be talking to your advisor or, checking in or different things like that?
Yeah, I think ultimately it is personal, because we have
Mhm.
some clients that want to talk once a year, or sometimes it's hard to get them even that
Yeah.
often. I would say that the norm is probably semi-annual in good times and then quarterly in difficult times, right? But every client is different. I want to avail you ladies that if you are nervous about reaching out to your advisor because you're worried about what the performance looks like, just tell them up front. I'm not interested in looking at the account. I've been avoiding it. I'm not looking at my 401k, because I know a lot of people said that last year. I'm not looking at it. Just getting an update and getting a refresher on why you should still feel good and what is working can be done without needing to look at your values. So don't feel self conscious about saying that out loud. I've literally started our strategy sessions with clients saying we can or cannot look at performance of the account if you would like. And they laugh, and some of them have said, yeah, I'd rather not. So there's still more work you can do even without looking at that.
I love that. And yeah, just kind of let them know at the beginning of the conversation where you're at, feeling wise about it. If you are anxious, that's fine. We don't have to go that route. If you're interested, sure, we can dive on in.
And I think, for example, if you were to call your advisor and kind of just try to understand, all right, I was supposed to have the safer bucket in bonds. Why are those going down? And having someone explain to you why what is happening.
Yeah.
It's like any other, event in life that's difficult. When we can gain control through information, that
Mhm.
really does help. And I found that arms our clients to feel a little bit better about, at least I understand what's happening.
Yeah, that makes a lot of sense. Because yeah, what you don't know can just scare you just because you don't know why. And so then you're like, is this going to be dramatic or is this just going to be insignificant in, a matter of months?
Yeah. So let's put in perspective last year. So we went from interest rates at 0 to interest rates at 4.5%. So if you look at this year, why should I be invested now? Why should I keep adding money? It's really easy to look at the fact that we've already done a 5% interest rate move. So
Mhm.
what is the likelihood that that's going to repeat itself this year? We feel, and a lot of folks feel, that there's only so much further that interest rates can go up or should go up based on fundamentals. And that's why this year should be very different than what happened last year, as an example of the type of information that's helpful to benchmark what you're
Yeah.
doing.
Interesting. Yeah, this is all new knowledge for me. And so I'm excited to learn that. And just it does give you a peace of mind because that makes much more logical sense. So now I'm not expecting another 5% raise. Um,
Correct.
yeah. And then as we get closer to retirement, we have our savings that we've been working on and saving up, investing. But then we have, Social Security. And people are
Yeah.
always wondering what they're going to get there, all that information. Can you give us a little insight of like how to find that out, if you can find that out, all that good stuff?
Absolutely. So when it comes to Social Security, I find that's probably the biggest place that when women come in and they sit with me in the first meeting, they're very nervous about how am I going to piece this all together? And it's almost that bonus of like, hey, by the way, you get Social Security. So um, in the past, Social Security used to send a pamphlet, like insert to your house every year with what your estimated earnings and your benefit would be when you retire. They have stopped doing that. My understanding is every 1 in 4 years, and I've heard clients say I haven't seen it in like a decade, right? So if I could share my screen again,
Yeah.
what you want to do is to go to ssa.gov. Hopefully, can you see that, Maggie?
Yeah, it's just a sign in.
Yep. So
Yep.
just if you want to Google SSA.gov, which stands for Social Security Administration, or just Google Social Security Administration, there is a place that you can go to log in. And if you don't have a login, you just create an account. And what that's going to allow you to do is to create a login where you can go in every single year and see what your estimated benefit is. So what they're going to show you is a range between age 62 retirement and age 70. That's the beginning of when you can start, and the last year in which you can start, 62 to 70, what your estimated check will be. We tell people to prepare that Social Security is probably going to be about 1/3 of what you'll need in retirement each month and year to cover expenses. But of course, again, that's really personal. So if you're someone that doesn't spend a lot of money, it could be a little higher, maybe 1/2 of what you need for expenses. And if you're someone that lives in an area like we do here in Connecticut,
Yeah.
it could be a little lower. So it is personal, but this gives you a way to get a sense on where you're at today with your earnings at work and how much Social Security might provide you when you do press that retirement button.
Awesome. And so that's, a great resource just to check out to see, what you might be expecting. Because I know sometimes right at the beginning, it might just seem like you could throw out any number and it could be true. You don't always know how that's calculated, but to keep your eye on it as well to make sure it looks accurate, make sure everything's really adding up.
And I'll throw out too, for anybody that's joined this call today, we do have this great piece from one of the partners that we use. They're one of the investment managers that you may or may not own if you have a portfolio with us. And they have this 10 key facts about Social Security benefits. So as a follow-up, if anyone's interested in that, I'd be happy to send that to you.
Awesome. Awesome. We can make sure we write that about that in the comments as well so people can tune in and check that out. That's great information. And I know then sometimes, and I don't want to get into all the Social Security details right now, but people can pull off their spouses or their ex-spouse's Social Security. Would you see that when logging in? What kind of information would you need to kind of get that access?
I do recommend for my divorced clients to call Social Security. There is a local office in your area that you can call and to talk through that. What I have found is that my divorced clients from time to time may have trouble getting logged in. That could be serendipitous, but I feel like I've noticed a trend. So I think in that situation, it's better to call. If you were married for 10 years or more, you do have the ability to potentially draw on your spouse, your ex-spouse's earnings history. But it will just come down to whether or not the check that you earned on your own work history is higher than half of the check of theirs. And we know, again, with different breadwinners and families, sometimes that really is a big benefit that women had no idea that they had access to.
Right. Especially, as women, the women who are retiring now, we're definitely more stay-at-home moms out of the workforce. And so this can make a huge difference, if you were out of the workforce for a long time, since your Social Security is an average, I think, of 35 years of work experience.
Absolutely.
Something like that.
They look over the entire period. And ultimately, you need to have 40 quarters or 10 years of work. And then it's a very complicated formula on how your benefit works. But yes.
Awesome. Awesome. I feel like this has been a ton of great information today. Is there anything that we didn't touch on that you want to make sure is shared with our community?
Yeah, I think you would ask me, what does a first meeting look like, right?
Oh, yeah, definitely.
I would say, so one of the things that I think is the most intimidating part is sitting down with a professional. Anyone that you meet with, number one, you want to ask, are they a fiduciary, which means that they are under a standard of acting in your best interest. That's a really important point, one that I hear a lot of people who've done research come in with. But ultimately, most advisors will sit with you for a meeting and do sort of an educational session, which is the opportunity to get to know you, for them to get to know you and you to get to know them and really decide if it's a fit. And so that's how our meetings, our first meetings are usually 30 to 45 minutes. I want to understand what's important to you. And if you have a challenge they're the type of challenges that we can solve here. So that's what a first meeting usually looks like. And then from there, then we talk about setting up a separate follow-up to do recommendations and decide how we want to move forward if we do. So.
And what I love about that is really figuring out for both of you if you'd be the proper fit. Because sometimes people, we always like to emphasize that nobody's cookie cutter. And even though you might think that your situation is very routine, I'm sure somebody has a specialize in that, or somebody knows a little bit more. And so it's always great to have these conversations just to make sure that your professional understands where you're coming from. You guys, our values are aligned. And you really understand what those goals and those visions are.
Absolutely. And I think too, some different advisors have different software and
Yeah.
platform options. What I mean to say with that, for example, with us, we have a financial planning software very much like mint.com, but much more custom to your situation. That's something that, certain clients are really attached and excited about. So it's good to go in and see what exactly it will look like if you sit and work with them. My number one recommendation, I say it to people that are interviewing me, is whatever you do decide, you want to pick based on that gut feeling of, hey, I think I like this person and I can trust them. Likability and trust, that's what it's all about.
It's 100% true. Sometimes we joke that you have to get financially naked with that person, and that can be very exposing sometimes. So you want to make sure you're comfortable with them. You don't want to be hiding anything, because they're going to help you live your best dream, but they just got to know the ins and outs as well.
Absolutely.
And like you started with, you're in Connecticut, but you serve all over, so people can book and make a virtual appointment, and just jump on a Zoom or whatever that is for you, and really have this conversation.
Absolutely. I would say my email is running across the bottom of the screen, so feel free to reach out and setting up a time. And also happy if you say this is just off the educational session, I have a couple questions. To me, it's all about what goes around comes around. So doing good things, putting good education out is good. So.
Awesome. Well, I appreciate you come on today and providing your expertise. I think this has been full of great information, and I even learned a lot, just kind of calming that anxiety about the market in the past year. And even if you're close to retirement, I'm sure you have a lot more anxiety about it. So I'm sure this helped out as well. I'm nowhere close to retirement, if you couldn't tell. But no,
20 years, 25 more to go. So I feel you.
Yeah, exactly. So I know I have some time for the markets to go up, but for everyone else out there, I think this has been a ton of great information. So please feel free to reach out. Her email's been going through the bottom. She's also a Purse Strings approved professional, so you can check her out on our site, pursestrings.co. And yeah, I appreciate you coming on today. We'll be back again next week for another Money Monday.
Thank you, Maggie. I appreciate it.
Yeah, we'll talk to everyone soon. Bye.